Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to asset turnover and return on equity. We're going to do a trend analysis doing these calculations for multiple time periods so we can do some analysis of the effect of those ratios over time. Get ready. It's time to take your chance with corporate finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the blue area into our worksheet on the right-hand side, calculating return on assets and return on stockholders' equity for multiple periods. Information on the left-hand side, including the year, X0, X1, X2, X3, net income, bottom line number of the income statement, the performance statement, then the main components of the balance sheet, which represent, in essence, the accounting equation, assets equal liabilities plus equity, or total assets and total debt and stockholders' equity. For the accounting equation, if we were to add up the debt and the stockholders' equity, it would then add up to the total assets for all the way down here. Okay, so let's do our calculation. We're going to do the return on assets. So the return on assets is going to be net income, or our income statement number, representing performance, comparing that to total assets. Now, total assets is a balance sheet number. So when you have an income statement number and a balance sheet number, they have two different timings. So you might see then in certain books asking for average total assets, the most common average being the beginning of the period plus the end of the period divided by 2. We're going to just be using the amount given on the balance sheet, which would represent the end of the time period. If it was 12/31, that would be December, end of the year, whereas the income statement represents the whole range. It represents how we did performance over January through December. So we will then pick up the income statement number, $140,000. Total assets, the $2,653,000. Dividing that out, this equals the 140 divided by the 2,653. Let's go ahead and format this. Go into the Home tab, Numbers group, percent, adding a couple decimals, adding some decimals. And note that if you add more decimals, it's not rounded exactly. Always have to deal with rounding. We'll round it to 2 decimals here. We're going to put an underline in the cell above, Home tab, Font group, and underline. So we're at 528. Remember that we would always like this to be going up because we're looking at performance. The top number we would like to be increasing, obviously, the net income. The bottom number represents the assets that we're using, and you would think, you'd want this number to go up. But notice our goal really isn't to increase the assets here, because our goal is to be consuming or using the assets efficiently to generate net income. If we have assets that we are accumulating that we're not using efficiently, we should just be giving them to the owner in terms of dividends, in the form of dividends. So you might say, hey, wouldn't I want the assets to go up? Kinda, you want the assets to go up, but again, you want the assets to go up for the purpose of generating revenue. And again, if it's not generating revenue, you would distribute it. So we're seeing how effectively we're using the assets, the things that we have, in order to generate revenue. So it's 5.28% good. Well, it depends on industry, and it depends on our comparison to ourselves. So we compare to ourselves, past performance, and we always look to improve, just like everything. And then we compare to the industry standard to see if we're lining up with this industry standard and if we can improve there as well. So let's pick up the net income for year 2 so we can do some of that analysis. And then let's pick up the total assets. Dividing this out, this equals up to the 143 divided by the net assets. Let's go ahead and format this, selecting the cells before it. I'm going to use the Format Painter to add the underline and the percent. Go into the Home tab, Clipboard, Format Painter, selecting these items, and there we have it. Now we see the net income to total assets, which we can also call return on, just to be consistent, on assets, same thing. And that's going to be an increase. So that's good. We had an increase. Why did it increase? We can look at the two components of what we have right here. We could say, well, net income went up. So the top number, the numerator, went up. So that would increase it. And the bottom number went down. So that would tend to increase the number as well. So if we think about over here, net income obviously increased. And we see that the total assets then went down, which means we have less total assets on which to generate income. And we're still generating income, more income. So we're using those assets efficiently. And again, and that's good, because if the assets went down and we're still generating income, maybe we distributed some of those assets to the owners or something like that. So our goal really isn't just to accumulate assets in the company and just have a stockpile of like cash in the bank. That's not really what the goal is. The goal is to be utilizing those assets to generate revenue and make sure that we have what we need to conduct business there. So now we're going to go, okay, net income for the third year is going to be $165,000, and then the total assets is going to be the $2,285,000. Dividing this out, this equals to 165 divided by the 2285. I'm going to format paint again, selecting the two cells prior, Home tab, Clipboard, Format Painter. Select these two cells. Okay, we have a similar trend, an increase. So again, that looks good. Year over year, we're looking better. We're going to compare it to the prior performance and to industry standards here. So see if we have a similar trend in the industry as well, and see if we're on par with the percent in and of itself with industry standards as well. So net income then increasing, so that would increase it. And then once again, the total assets went down, which is, like I said, isn't necessarily bad. That means we're making more income with the use of less total assets in order to do so. And then we're going to go to X3, which is going to be the 258, and comparing that to the total assets. And if we divide this out, this equals the 258 divided by the total assets. Let's go ahead and format that one. I'm going to select the prior to, Home tab, Clipboard, Format Painter, and select these items. Once again, it's going up. So that's a good trend overall. The net income has increased. Once again, good trend. The assets went up this time, so total assets went up. But it looks like, so we had the denominator goes up, but it looks like the net income is going up at a higher proportion, in that the ratio is increasing. So numerator and denominator went up. So we have more assets. Maybe we purchased assets or something like that. But it looks like those that we purchased, we were able to use efficiently in the business to increase basically the bottom line number, the net income. Okay, so let's do the return on stockholders' equity, which is going to be net income divided by stockholders' equity. And that's going to give us our return on stockholders' equity. So if you think about this ratio, we're looking at, once again, income statement number being net income performance number, comparing it then to, I'm sorry, not total assets, to the stockholders' equity. Comparing it to stockholders' equity to get the return on stockholders' equity. So we're looking at net income performance number. We're looking at equity. So notice that equity represents, you can think about it two ways. Accounting equation is assets equal liabilities plus equity. Assets is what the company owns. Liabilities and equity are who has claim to it. You can rewrite the accounting equation as assets minus liabilities equals equity, which is in essence the book value of the company. So you can think of this as kind of like the book value of the company, assets minus the liabilities, compared to the income. So the performance number compared to the net assets that the company has, the net value of the company, you can think of it. And so how much income is being generated based on the net value kind of the company. Okay, so then we're going to say net income is going to be then for the first year 140. Stockholders' equity is going to be the 794. And so if we compare those two out, we're going to say this equals the 140 divided by the 794. Let's go ahead and percentify this one by going to the Home tab, Numbers Group, percent. We'll add a couple decimals to it, and we could keep going, but we're going to round it to 2 decimals. Let's put an underline up here. We're going to go Home tab, Font Group, and underline that. So we have the 17.63%. So net income represents the performance number. Remember, stockholders' equity is a balance sheet. Those are two timing difference amounts. So in other words, you have the income statement range, balance sheet point in time. Therefore, you might see a textbook or something say you want to have the average, which would be the beginning of the year plus the end of the year divided by 2 is the most common average to take. So we're looking at the performance of the net income, and then the equity, kind of like the book value. Is that good? Once again, we would have to compare it to our trend analysis and to industry standard. We would like it to basically be higher. Higher would typically better. That would be meaning that we're making more net income on what you can think of as like the book value, assets minus liabilities of the company. So then we're going to be saying that net income is 143 for the second year. The stockholders' equity, 1,287,000. Dividing this out equals the 143 minus the 1,287,000. Let's format paint these two cells. Go into the Home tab and Clipboard Format Paint. Paintbrush these cells. You can see this going down now, which you could say, well, that's not as good. That's not good necessarily, because you're seeing less income being made as compared to the book value. Now, if you look at the net income, it went up, so you would think that would be pulling up this ratio, but the stockholders' equity went up by a lot more, which in and of itself might not be a bad thing, but you're saying, well, the ratio of the net income performance compared to the book value has now gone down. So meaning our performance based on the net assets has decreased. So that, why did the stockholders' equity go up? You can take a look over here and say, okay, well, if we think about this, assets equal liabilities plus equity, the debt went way down and the stockholders' equity went up. So maybe there was some financing by the owners or something like that, and maybe debt was basically paid off with it, which overall could be a good trend, even though the return on stockholders' equity is going down. In any case, net income, next one, we're going to say net income is going to be the 165. And notice this is how you'd want to do these analysis. You'd want to then tell the story as to why they increased or decreased here. And then we're going to say the stockholders' equity is then going to be the 1,503,000. And dividing this out equals up 2 divided by up 1. Let's format paint this, selecting the prior two. Home tab, Clipboard, Paintbrush that on over. Once again, we have a decrease going on here. Why? Because net income went up. You would think that would be increase in the ratio, but then the stockholders' equity also went up once again. So if we look over here, the breakout between stockholders' equity, you can see the debt is going down again, and the stockholders' equity then going up. So if you look at the total assets, relatively, went down a little bit. The debt went down and the stockholders' equity went up. So maybe financing maybe paid off some of the debt. So next item, we're going to say X3 is going to be the net income, and we're going to be saying the stockholders' equity. It's going to be here, dividing this out. This equals up 2 divided by up 1. Let's format paint this, selecting these two, go into the Home tab, Clipboard, Format Painter, and paint this on over. So now we've got the 10.98, and it goes down a little bit once again to the 10.20. Once again, the net income went up a lot. So you would think, or when the net income is increasing, that would increase the ratio. And down here, though, the stockholders' equity once again is going up. So if we look at the trend, we're going to say the total assets went up this time. So again, maybe the capital investment went in to increase the total assets, but the total and payoff debt, the total debt once again is going down. So you got a decrease in the debt, and therefore the stockholders' equity going up. So if you're going to compare these out, the proportion of equity compared to liabilities as a proportion of the total assets, the equity has gone up and the liabilities portion has gone down.